Would you like to pay less or even no tax on your pension drawdown withdrawals and make them as tax efficient as possible? In this video, we're going to explore the various ways that you can use Flexi Access Drawdown to take a flexible income from your pension and at the same time reduce or even eradicate your tax bill. For each option, I'm going to give you an example and show you the withdrawal and how it would work and what the taxation would look like. When it comes to your pension and drawdown, you may know that usually 25% of your pension is tax-free, with the remainder taxable at your marginal rate of income tax. What this means is that you take any money from your crystallised pension, which basically means when you take benefits from your pension, this will be treated as income and subject to income tax at your marginal rate, which basically means it takes into account any other income that you may have, such as your salary, rental income, or your state pension, to name a few. So let's say you were a basic rate taxpayer, you'd previously taken all of your tax-free cash and crystallised your pension. If you had then taken a withdrawal from your crystallised pension funds, tax of 20% would be due on the withdrawal. If the withdrawal from your pension pushed your income above the basic rate tax threshold of £50,270, then the surplus amount above this would be subject to income tax of 40%. What you may not know is that it's possible to take a combination of your tax-free cash and also taxable income from your crystallised pension fund to provide a tax-efficient or even tax-free monthly income from your pension. After all, who doesn't want to pay less tax, right? With this option, you can stipulate exactly how much tax-free cash and taxable income, crystallised funds, you want to take to maximise the tax efficiency and utilise something called your personal allowance. Your personal allowance is the first £12,570 of your taxable income, which is taxed at 0%. So if we assume you've got no other income, you can then take taxable income from your pension up to this personal allowance amount and then take the remainder from your tax-free cash to create a tax-free income. Now look, I know, this talk of crystallised pensions and allowances can be confusing, so let's see an example. We'll use good old Terence, who we've turned to in the past videos for some examples. So Terence is retired at age 63 and his pension is worth 200k that is fully uncrystallised, which means he hasn't taken any benefits. He can take 25% of the uncrystallised pension fund tax-free. So he's got no other form of income as he's not yet reached his state pension age and he needs around 24k this year. As he's got no other income, he has all of his personal allowance remaining, which, if you remember, means the first £12,570 of his taxable income is taxed at 0%. So using a tax-efficient income, Terence can withdraw £12,570 from his crystallised funds, which will be subject to income tax. But hold your horses, although these funds will be subject to income tax, as it is up to his personal allowance, the income tax will be in effect 0% and no tax will be due on the withdrawal. Okay, so we know he needs 24k and if he takes £12,570 from his crystallised funds, then he's still going to have a shortfall of £11,430. So how can he make up the difference? Terence can simultaneously take the shortfall amount of £11,430 from his tax-free cash. By doing this, his effective tax rate would be a whopping 0%. What I find many people do when they get to retirement is simply take what they need from the tax-free cash without regard for making use of the allowances and thinking about trying to structure their income as tax efficiently as possible. If Terence had simply taken the 24k that he needed from his tax-free cash, then he wouldn't have made use and took advantage of his personal allowance, which is taxed at 0%, if you remember. This mistake, or opportunity cost, if you like, could be as much as £2,500 if we assume the personal allowance tax-free amount that he didn't take advantage of was then taxed at 20% in a different tax year, or when his state pension kicked in, which filled up that bucket. With the state pension age rising, this option can be particularly useful if you take early retirement before your state pension and you might have no other income. Once you or Terence are then in receipt of your state pension, you can then simply reduce the amount of income that you need from the drawdown pension which would help the sustainability of the pension fund or even change the income strategy to reflect the new income that you get elsewhere. If you take some or all of your tax-free cash, this is known as a Pension Commencement Lump Sum. Moving forward, I'll call this a tax-free cash withdrawal, as I'll run out of breath if I have to say that every time. As an independent financial advisor, one thing I'll often hear from clients approaching retirement is that they often want to take all of their tax-free cash at once, even if they have no specific purpose for it and may just want to stick it in the bank. They'll often think that if they only take a part of their tax-free cash, or if they don't take it all, they'll lose it. This couldn't be more wrong. It's actually possible to take a series of smaller tax-free lump sums, or you can even take a monthly income made up entirely of your tax-free cash, which would result in, yes, you guessed it, paying no income tax. The amount of tax-free cash you have is usually 25% of the uncrystallised pension fund. It is not simply the starting value. If you've taken some of your tax-free cash or pension benefits, it should be easy enough to find out how much of your pension remains uncrystallised by looking at your pension statement or simply giving your pension provider a call. So let's see an example of how you can use your tax-free cash to create a tax-efficient income. So John is retired and has a pension worth £100,000 that is fully uncrystallised. He needs 4k to cover his expenditure and has turned to his private pension to meet this. He is a basic rate taxpayer, so if he took any withdrawals from his crystallised pension, the taxable side of his pension, they will be subject to 20% income tax. So John can take a monthly tax-free cash withdrawal of £333 a month, 4k a year, to meet the shortfall. He'll not be able to do this indefinitely, as he's eventually going to crystallise all of his pension, which basically means he'll have no tax-free cash remaining, and when he does take crystallised funds, they will be subject to income tax. If we assume no investment growth, this will be in approximately 6 years when he uses up all of his uncrystallised funds. There are two benefits of taking this withdrawal from his tax-free cash. It's not just an arbitrary 25% tax-free cash amount of the starting pension. It's typically 25% of the uncrystallised funds within your pension. If his uncrystallised funds increase with future investment growth perhaps, then so will the amount of tax-free cash in absolute monetary terms. Secondly, back to the personal allowance that we keep harping on about, in which any taxable income is taxed at 0%. If the personal allowance increases by the time John comes to take taxable withdrawals from his pension, then more of his income would be free from income tax. However, it is worth noting that the personal allowance, and I'll accept this, has been frozen until at least 2025, and it doesn't look like it will increase beyond that, so it might not apply. Although, interestingly enough, the personal allowance was, back in 2015-2016 tax year, £10,600 and has risen to £12,570 today. So if this was you back then, delaying taking any taxable income from your pension would have paid off. Another way you can take a tax-efficient withdrawal from your pension is to take an uncrystallised fund pension lump sum, or UF plus for short. An UF WTF, you may be asking? But with an UF plus, 25% of the withdrawal is tax-free. The remaining 75% comes from the crystallised pension, which, if you remember, will be subject to income tax. Breaking this down, if you took a 10k withdrawal as an UF plus payment, then £2,500 will be tax-free, and the remaining £7,500 will be classed as taxable income. You can take a monthly UF plus from your pension to create a tax-efficient withdrawal. Let's see a case study of how an UF plus would work in practice. So Fred is retired, and his state pension and defined benefit pension comes to £15k a year. If John takes an UF plus payment of £10,000, and as we've said, 2.5k will be tax-free, and the remaining £7,500 will be subject to income tax of 20%. This means the tax payable will be £1,500. This is an effective tax rate of 15%. If Fred had just taken the funds from his crystallised taxable pension fund, the tax charge would have been £2,000 or 20%. Taking the withdrawal as an UF plus for Fred would have saved him £500 than if he had just taken it as a straight up income payment from his crystallised funds without thinking of making a tax-efficient withdrawal. It's important to understand how drawdown works and the various ways you can take a flexible income from your pension, but watch this video, which gives you an idea of how much income you might expect or be able to take from your pension based on different fund values from 100,000 up to 500,000, so you can relate it to your own circumstances.